Great, everyone, here we go. This is the top of the hour. Let's get started. It's Trading Tuesdays with Kathleen Brooks, myself, at Forex.com. I just want to point out our disclosures and the fact that foreign exchange and other leverage products involve significant risk of loss and are not suitable for all investors. And increasing leverage does increase risk. On the other note, anything I say here isn't a recommendation, a trade recommendation as such. So please do bear that in mind. Also note that if you are if you are based in the US, CFD products, our CFD products are not open to US clients, and that is because they are not regulated over there. It's for regulatory reasons. Okay, everyone, let's get started. Let's find the interesting stuff. I am going to start actually by looking at some stock market. So bear with me one moment. I know I don't usually do this, but I thought I would today because there's been just some really interesting lessons, I think, over the last few days. And just one other thing that I wanted to tell you. If you do have a question for me, can you write it in your Q&A box? Because then I'll see it and then I'll be able to answer it just so that it doesn't get lost. But anyway. Hi everybody, let's get started. I'm going to start, as I said, with some stock market. I think some of the price action recently has been a really good lesson. So not a really good lesson in just patience really, and how if you jump on the back of a trend too early, you can really lose a lot of money. Let's just take a look at the S&P 500. This here is the candlestick chart with the daily moving averages on it. Now the yellow is the yellow line is the 200-day moving average. And what does this show you straight away? Well, I'll tell you. Firstly, it shows that we had a weekly close below the 200-day moving average on Friday. So the S&P 500 closed closer to 1350, well below that 1380 level. Usually you get a fall below a 200-day moving average and a weekly close below a 200-day moving average. Those things can be considered a really bearish development and can sometimes trigger algo selling or trigger moves elsewhere. So those can be big signals that people use to establish whether or not, maybe we're in a downtrend now, maybe I'll continue to sell this. However, that was not the case. What we saw yesterday was a sharp jump higher. Now there were a few reasons for this. There are a few reasons why we shouldn't have thought at the close on the S&P on Friday that this meant further declines for the S&P 500. Number one, because primarily because of fundamental issues. We had the President of the US and the Republicans basically in the House of Representatives meeting. They met and they discussed the fiscal cliff, and there seems to be some sort of middle ground that they're coming to. So there was positive fundamental sentiment there. Obviously the market very, very worried about the fiscal cliff, so any positive sentiment that we get can really boost the upside. Then also there was issues on Greece, potentially Greece, the Eurozone finance ministers sorting Greece out, making sure that it didn't, default or anything like that. However, from a technical basis, there are issues there as well. Yes, we had fallen below the 200-day moving average, for sure, but 1350 was always going to be a very important level of support as well. Likewise, if you just look at the volume indicator down here, remember whenever you trade equities, it can be very important to, or it's certainly worth looking at the volume indicators, because usually if we're embarking on a new trend, we would see volume spike up, and as you can see there, volume really hasn't spiked up. It's Thanksgiving week in the US. I mean, you just have not seen that spike in volume, so really, really worth looking at everything together rather than just looking at one signal, which was that weekly close below the 200-day moving average, which is a powerful signal, don't get me wrong, but it just shows that sometimes it isn't always right. So what we saw yesterday was a sharp move higher in the S&P 500 immediately at the open, pretty much, as you can see there. Just look at the candlestick, it really shows that we were just higher all day. We didn't even get, it does not have a lower wick. We just moved higher the whole day, which got us back above that 200-day moving average. Now, I'm not saying that we're back above it, that we have cleared it, that we are now, going to hit 1450. That's not what I'm saying. Look at this candle. As you can see here, this candle doesn't suggest to me that we are necessarily moving higher. Also, if I just show you the Ichimoku cloud We are still below the Ichimoku cloud, again hitting quite strong resistance there at 1385-ish, thereabouts. We're not really going to be positive about this pair until we get above this 1414 level. So there's still quite a lot of way. I would just say one thing is that it doesn't necessarily, right now the market hasn't made up its mind which way it's going to go. Now there are a few domestic, or there certainly are a few issues or a few fundamental issues to think about when you're trading S&P right now. We've got Ben Bernanke's speech later today. It'll be interesting to see what he says, whether or not he gives any clues as to what's going to happen at the December FOMC meeting. Remember, Operation Twist, the Fed's policy for most of this year, comes to an end in December. So are they going to boost QE3 to make up for that? We need to know, and we think he may signal that later today. Obviously, if he does signal something that suggests accommodative monetary policy, then we would expect the S&P 500 to do well. So that could be what gets us back above 1400. And what could potentially cause that, combined with positive sentiment coming out of Washington surrounding the fiscal cliff, is what could cause another rally back to that 1450, those highs that we saw earlier this year, kind of in July and August this year. So do watch out for that. Now, the other thing I want to show you is the FTSE index as well. As you can see, very similar price action. The difference is that we've got today's price action because the UK markets are actually open. Obviously, US markets aren't open. I should have actually said that before. But we are stumbling around this 200-day moving average in the FTSE 100. FTSE 100 has moved fairly closely with the S&P 500 this week, well, really over recent months. And we've seen the 200-day moving average, obviously, it's acting as a very, very harsh resistance zone now. So, yes, we may have got a false break lower, but we're not necessarily about to embark on some sort of move higher, largely because, the markets, as I said, they are uncertain. We've got this Bernanke meeting, we've got the fiscal cliff, we've got Greece. Fiscal cliff and Greece is certainly not, they're not in any way resolved right now. Added to that, we don't know how to think about the Fed yet, because we need to hear whether or not there will be more QE. If there is, that's probably going to be considered quite a good thing. Right now this morning we had Japan. They avoided doing more QE, even though we think there's some more waiting in the wings. But it just goes to show, at the moment, is something the real deal? Are we embarking on a trend? Are we going to see kind of sustained moves in one direction or the other? I would say certainly not today. And the concern is when we're in this environment, it's very, very tricky to trade. If anything, as I said, certainly for the S&P 500, we think that we could be potentially in a range between 1415 on the upside and 1350 on the downside. Now that's great, but it's when you're in the middle of it that's when it becomes a bit more problematic. So do watch out for that. We think at the moment it's probably pretty impossible to trade these indices. One thing though, if we did get back towards the 5,600 level here, very good support here in the FTSE 100, then that would attract some buying interest. So what we've really seen is that right now the market seems a little bit in equilibrium, which is hence why we're having one down day, one up day, one down day, one up day. Now yesterday, as you can see, we kind of really broke out of our most recent trading range over the last, say, 10 sessions by having this huge move higher. So we don't necessarily expect that today because obviously, we are waiting on some important news. Likewise for the UK index as well. We've got MPC minutes and public finance data tomorrow coming out of the UK. So both of those very important for the direction of markets for the rest of the year. Another thing that I would just say, no real change in volume here as well. Obviously, because the FX market isn't traded on an exchange, you don't get volume indicators, and volume indicators can be very important when you're about to embark on a change of trend, because usually what you see is volume start to pick up. So let's just go back a minute. Let's go back to 2009. And the reason why I show you that is that you can really see here, this is the start of, say, 2009. I'll just go back a little bit. Hang on. This is back in 2008. As you see, that spike higher in volume really did correspond with that sharp decline after the Lehman Brothers crash. Likewise, we kind of saw volume spike higher again on the way up. So volume is certainly worth watching out for there. It is kind of a key indicator really for the UK markets. The other thing that I would sorry about that. I'm sure that was some horrible noises there. I'm just readjusting my microphone. Apologies. The other thing, let's just move on right now, because obviously it's not just been the indices that have moved. It's also been oil. I just want to take a quick look at Brent. And I'm looking at Brent today. WTI was really in focus yesterday because of everything that was going on in the Middle East. But I'm looking at Brent because it's open. So let's take a look at this. Again, trading in a range. We have bounced back quite sharply. Obviously, that has been helped by what's been going on in the Middle East. Middle East fears really does cause oil to kind of move back higher. So it's bounced back from that 105 level. But it is getting stuck before 112, which is the cluster of daily moving averages. So there's an awful lot of resistance here, but basically if we get above here, it could open the way back to kind of a move towards that 115, 117 level, which was the highs that we saw back in September. Remember back then, the rally that we saw in oil from June to September was really fueled by a sovereign debt crisis in the Eurozone, but just calming down a little bit based on those Draghi comments. Right now, we could see oil move higher, not because of that, but also because of what's going on in the Middle East. Someone just said, I don't do currencies. I do currencies. We're Forex.com, obviously, that's why. And I mainly talk about currencies. But I think this is an important question, and is kind of important for you guys to mention, is that all markets move together. That no market moves in isolation. So when I look at things like indices, when I look at things like oil, they're all important. So as you can see in the indices, they all have relevance for each other, basically. As you can see in the indices, they're getting caught right now between kind of the bulls and the bears. Likewise, so is oil. Now, if I turn and look at euro, let me just go to my euro chart. Euro dollar also trading sideways. Let's just take a look here. Also getting thwarted by moving averages. Now that's very interesting, isn't it? Because it suggests kind of risk sentiment. Markets are moving in a similar direction, and that's kind of what anyone who follows into market analysis, into market technical analysis, should look at the market in that way. You look at equities, then you look at the dollar, commodities, equities. That's usually the route that it goes, and treasury yields as well. They're super important as well, or any government bond yield. Because investors have similar horizons. Most people don't just invest in one thing; they invest in lots of things, and so that's why risk sentiment can dominate all asset classes. So what we're seeing right now is just a bit of kind of a lack of direction in the markets. It looks right now like we're waiting on, some more fundamental driver. Now we're not seeing, we are seeing the downside protected, not just obviously in equities, but also in the dollar, in euro as well. And there are a lot of reasons of why that's happening and what that actually means. And one of the main things, one of the reasons postulated for that is because of what central banks are doing. So central banks are coming in, they're pumping the markets with liquidity. For example, today, let's look at right now. We've got a lot of risk events out on the horizon. Still no resolution to the sovereign debt crisis in Europe or the fiscal cliff in the US. Yet, the markets could potentially rally if Bernanke sounds dovish, like it's going to do more QE. That's the key thing. But anyway, on that note, and transposing it to the FX market, as you can see here, this is the daily chart. So there are a couple of things on this chart I want you to notice. Number one is this cluster of daily moving averages here all the way to 130, which suggests that if we are to move higher, if there is to be a jump higher, what we may see is a lot of stumbling blocks on the way up. There's a lot of opportunity to take profit, for example. 130 could be a step too far. It's going to have to be something good, I think, to get us to 130. I mean, we think there's probably a chance that may not happen. The other thing, though, I want to show you is that we've potentially got a crossover here. It looks like we've potentially got a crossover on the daily MACD. Now, that can happen. Sometimes the MACDs and the momentum indicators are actually lagging indicators because, obviously, they use historical data. So it doesn't necessarily mean that we're going to fire ahead. But if that does cross over, then that's also kind of a bullish sign. And right now, we are kind of in unison. So that's all good. Take a look at it on the 60-minute chart. As you can see here, again, just continually running into this resistance, short-term resistance at 128.20. Very good support, though, 127.65, and we've also got good support, 127.40, which is also the Tenkan line on the chart. So right now, actually, if I just show you something else, bear with me. I'm going to show you my Ichimoku cloud chart. I'm going to drag in here. We're in the cloud. When you're in the cloud, it suggests pretty much that you don't have there's no prevailing trend. Now, obviously, the fact that we bounced off support 126.53, and we have moved higher, we're obviously back up around about 128.20, it does suggest that there could be further upside, that we are, there could be further upside to come. We've certainly got support on the downside. We've had some higher highs, higher lows, that type of thing. Just in the last few trading sessions. So, all of this is quite positive. However, for us to kind of really sustain this momentum and to move higher, we need to really break above 129.50, which is the top of this daily cloud. Once you get above there, that is a massive level of resistance. Only when you get above there can you say really that you're in a technical uptrend. Now, as you can see, all through this year, we haven't had prolonged periods really above the cloud. We've spent more time below the cloud or within the cloud than we have above it. There was a period September, October. Even the end of August. We also had a bit of a period in February, March, but not in a huge way. The bears have had control. Now, what is quite interesting, if I just draw a bit of a line, just bear with me one moment. Now, there is, dating back from July, a bit of a support line. It's not perfect because obviously we only hit it kind of, twice in July, or once in July, once in August, and then once again now. But the fact that we've held this support is mildly bullish, does suggest that we might trade with a mildly bullish sentiment, but it doesn't suggest that we're going anywhere fast, that this is a very hard and fast type of trend. It suggests, if anything, it's more of a mildly bullish tone, and we would argue that as well. It feels like the markets in there have that view too, whereby the bears haven't got control, the bulls are holding the reins, but they're not really, giving the horse a good kick to get it started. People are taking their time, so they're cautious. Obviously, we would say there'll be caution for the rest of this week. Remember, it is Thanksgiving. It could be quite quiet out there. But it's more about, what will happen at the end of the year? Well, obviously 130, just such a massive level of support. The fact that we have got quite wide or widening clouds does actually suggest that we may move. Does suggest that we might be, that we are in, again, this kind of mildly bullish trend at the moment. But right now it's because we're limiting downside, not necessarily because we're making great tracks on the upside. But if we do get above 128.20, then the next level to watch out for, as I said, is, let me just take a look here, is this red line on the chart, which is the 200-day moving average. That becomes your next key resistance level of note, which comes in at 158.50. Now, the other thing I wanted to show you, I'm going to show it to you actually on this chart because it's euro sterling. Euro sterling, very much, definitely worth watching the next couple of days. It's going to be a big week for this pair, I think. The reason why I think that is because we've got, obviously, Eurozone Finance Ministers meeting coming out tonight, but then tomorrow we've got a lot of stuff that could move sterling. We've got the minutes from the MPC meeting. We've also got public sector finance data. Now, public sector finance data might be worse than expected. If that happens, that could potentially weigh on the pound because people might question the UK's credit rating, etc., or holding on to its long-term credit rating. But if the MPC minutes are fairly hawkish or less dovish than last week's inflation report, then we could see sterling regain some strength. Now, what do I think would win out? Would it be public sector finance data or what the central bank is doing? I argue it would be what the central bank is doing because they could sort out all the mess around the public finances. So in that sense, hawkish minutes from tomorrow's MPC meeting, which is released at 9:30 London time, could cause this this cross, euro sterling, to back away from the top of this Ichimoku cloud, as you can see here. Let me just draw a circle. So as you can see, we're testing this level at 80.40, currently settling around this level. We haven't really got any too much traction on the upside, but going forward, you know, there are a couple of, as I mentioned, those fundamental drivers, both from the UK and Europe. A dovish or any signs of dovishness from the MPC would help the upside for this, but any signs that the MPC are actually you know, questioning the usefulness of QE could really weigh on the pound, could really help boost the pound. Now, if we get that coupled with the disappointment from the Eurozone Finance Ministers meeting, then we could sharply back away from this 80.40 level. Obviously, the next support there is 80, but then we also have 79.65, which is the base of this cloud, so just the green line here. So do watch out for that. Obviously, we've had some nice strength in euro sterling the last few sessions. I think the risk is potentially to the downside if we get that mix of events. So if those fundamental events turn out whereby we get a disappointment from the Eurozone Finance Ministers meeting, combined with more hawkish than expected minutes from the MPC. The other thing, though, that we would point out is that what if we don't get that? What if we get the opposite? Well, in that case, you know, it's very difficult to predict which way things will go. I think what you need to do is lay out scenarios. So that's my first scenario. My other scenario is that the Eurozone Finance Ministers meeting actually causes the market to rally, and then the MPC is more dovish than expected, or as dovish as King was, and we may break above the top of this kind of 80.40, maybe even get above 80.60, which would then really open the way for a move back towards 81.80, which was the high from October. So they're the kind of the couple of scenarios that I would point out. Think about some strategies around them. Obviously, you know, the break above 80.60 would be quite bullish and could potentially see further gains towards 81. A break above 80.40 may trigger or a daily close above 80.40 may trigger some buying interest in this cross. Now, the other thing I want to show you is yen. Dollar yen, as you can see here, let me just draw the other one. It had a nice move higher, but it has backed off a little bit. That was after the Bank of Japan left interest rates on hold. What we've seen is the yen actually just regained a little bit of strength, but not enough really to worry us that this is over. We do think that the biggest risk to this cross right now is the Fed and Bernanke's speech later, with him being very dovish and suggesting that QE3 is going to be even bigger than we expected. Any signs of that, we could see a sharp move back towards 81. So do watch out for that. That takes place. His speech takes place at 5:15 London time. Any sign that he is really getting more and more dovish could be greeted kind of almost with dismay, but also with kind of dollar weakness, so do watch out for that. Now, I am aware that I've spoken kind of non-stop for like 25 minutes, so if you've got any questions, please let me know. I'm more than happy to answer some of your questions. Just jot them down in your Q&A box or your chat box if you can't see your Q&A box. I'm happy to take a couple of questions. And as you're thinking about your questions, I would be quite interested really to hear, just to get your sense on whether or not you think that that we could rally into year end. I know that I've asked this last week, but it's just interesting to see whether or not you expect that kind of Santa rally or markets to strengthen into year end. If you just jot down a quick answer whether or not you think rally or not. Okay, so there's some good there's some good mixes here. Some people think it's going to rally into year end, with some thinking that we could potentially see a decline first and then a rally. I think that probably does make sense. There's a lot of event risk out there, so if that event risk goes well, then we could definitely rally. If it doesn't, then we could certainly fall back. But central banks do seem to have put a bit of a floor into this market, so there's quite a few. There's mix now. You're all coming through. Rallies are coming through. Some people are expecting some weakness. I think my biggest risk for stocks rallying is that fundamentals aren't there. We've seen very weak kind of sales outlooks, etc. Okay, the last thing I want to show you then is gold. Let's take a look at gold. Gold, as you can see again, sorry, wrong one. Gold is really kind of range bound, but it has been, it joined in that overall commodities rally yesterday and the European stocks rally. It's moving very much with kind of overall risk appetite. So it's moving with what's going on in the US. It's moving with what's going on in stock markets and also in kind of other commodity markets like oil. So it's not moving on the back of its own fundamentals. As many people have actually pointed out, as there's been kind of a huge interest in gold, it doesn't have its own fundamentals. It really doesn't have its own fundamentals, so no wonder it moves on the back of other things. Again, more sign of QE3 from Ben Bernanke today could really get us above this 50-day moving average at 1740 and could maybe get us even to see that kind of a retest of that 1800 level. Remember, there's a nice double top there, right just below, so just at that 1795 level. That comes from the end of say mid-October or early October. That's been the kind of the key resistance level to note. But we do think that gains will be thwarted there, but the gold has really proved itself to be the ultimate QE3 trade. So any signs that there's going to be more QE3 or more policy stimulus from the Fed then later on today, then we would expect gold to stage a sharp rally. Someone's just said that they think yen pairs topping and could retrace 50% or so of their lows from the year. Some people have argued that actually the yen is let's just take a quick look at it here. This is an annual chart, year chart. Let's also take a look at our 50% fibs. This kind of 81.10 level is very, very good support. I think whether or not we do retrace in dollar yen will be very much dependent on the Fed. They're going to have to do some pretty aggressive QE to get us lower, because I think whatever happens, we've got an election in Japan on the 16th. The likely new leader is going to be very harsh on the Bank of Japan to actually boost more stimulus and bring down the value of the yen. It's about the only thing they can do to boost their economy right now. So I think with yen pairs, do watch out, because there's a lot of politics on both sides of the fence that could really make this pair actually very difficult to trade into year end. But as I said, we would expect some buying interest ahead of what 81.10ish, 05 to 10, and if we are to see kind of a reversal in this move higher, then 80 would be a very good support zone as well. So do watch out for that. I think what Darji has just said is that most yen pairs are near topping. I think that's, it's a cautious trade. Be cautious with it. It's a longer term trade as well. Widen your stops, have quite a wide profit, have quite a wide, take profit level. Make sure that you give yourself enough room, because as I said, my problem with dollar yen and with trading it at the moment is that there's an awful lot of politics on either side that are going on. In terms of what are the things I prefer trading at the moment, it's probably things like indices and stocks. Also, you know, I like the idea of gold. I like the idea of kind of quite easy things that aren't affected too much by politicians. That puts the yen just on ice for me just for a moment. But I would say that if we get back towards that kind of 81.10 level, maybe even down to kind of 80.90, 80.70, I would expect buying interest to come in then. And for people, it seems, you know, the trouble with the yen rally that we saw last week is that it wasn't really backed up by every element of the market. So we saw a lot of hedge fund buyers in, but we need to see kind of real money come in as well, and a lot more of it to really give this rally some strength and some wings to get us back to those kind of February highs at 84. Okay, everyone, it's 10:30. I want to say thanks very much to all for joining. Good luck trading this week, and please, if you can, do join us next week for more.